How to invest $1,000 in 2019. This is your guide for the 7 best investments you can make this year, the risks, the outlook, and how much you can expect to earn. By the end of this video, you'll have an investment strategy that won't depend on stocks, that'll be safe from a recession, and that will make you money. We're talking best investments for 2019 today on Let's Talk Money. Beat debt, make money, make your money work, creating the financial future you deserve. Let's Talk Money. Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here with us. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. This is going to be an epic video. How to invest $1,000 in 2019, the best investments and the outlook for each. Now we're going to be talking about 7 different investments you need to make this year. And this is going to be an important part. You might not invest in all of them, but you should know about them and have at least 3 or 4 in your portfolio, and I'm going to tell you why. Everything we've seen is pointed to 2019 as a turning point for investors. We'll go over the risks in each investment, but those broad economic risks are building, and a recession in the latter half or in 2020 is looking extremely likely. That means some of these investments could start selling off mid-year, so you need a mix of each because they don't follow the economy in the same way. This isn't going to be some generic how-to investing video. I'm not going to lecture you on paying off debt or building an emergency fund first. All that stuff is well and good, but this video is going to be pure investments. You've got $1,000 and how do you invest in it for the highest return possible with the least amount of risk. Now it's going to be a longer video, but I want you to put it in your watch later folder because you're going to be referring back to it all year as a complete investing guide in stocks, real estate, art and collectibles, gold, startup investing, those peer-to-peer loans, and business investments. For each of these 7 investments, I'll cover the outlook, risks, and exactly what you can expect for returns. I'll be hitting some deep analysis on each of these and how it fits with your overall wealth building strategy. In fact, this is the same strategy outlook I use to provide private wealth clients and institutional managers. Each year, I would get the team together and everyone would take an asset class to research. Then we'd all round robin each to narrow it down to a few core sets of investment recommendations. I'll leave a clickable table of contents in the video description below so you can jump to the outlook in different investments, but I urge you to watch all of them. If you've got $1,000 to invest, the last thing you want to do is put it all in one investment and watch that investment tumble all year. Building that portfolio of at least a few of these investments is going to smooth out those risks and get you the highest return possible. In fact, towards the end of this video, I'm going to reveal my top 3 investments that should be the core of your portfolio, the 3 with the highest potential in 2019. I'm also going to be sharing a link to a free report I just released exposing the top 10 lies Wall Street tells investors. These are the worst 10 deceptions I saw Wall Street use while working as an analyst. Lies that keep you losing money, and I'll be giving you a link to that free report at the end of this video. We're going to start with stocks, but first I want to get your opinion on to see where the community is on all this. What do you think is the best investment for 2019 between stocks, real estate, bonds, and gold? We'll cover a few others, but I want to get your input on these 4 assets for which is best in 2019 and why. So scroll down, you can do it while the video is playing, and tell us in the comments below. It's important because if you know where you're standing first, then you can start to see those ideas and the reason for or against. So scroll down and tell us in the comments, stocks, real estate, bonds, or gold for 2019 and why. Now we'll start off with stocks, but it might surprise you how little you should have in equities. This isn't because of some imminent stock market crash, but the simple fact that stocks aren't going to make you rich or get you where you want to be. Now, Scorpio and BNP Wealth Management surveyed their highest net worth clients. This was a survey of 2,500 people with an average net worth of almost $8 million in assets and found that on average, the rich invest less than $1 in $5 in stocks. The rich have just 17% of their money in the stock market, and for some regions, it's even as low as 14% in equities. And that's because the rich already know what we're going to be talking about in this video, that there are other investments you can make besides stocks that are going to grow your money faster and are going to protect you from that stock market crash. Now, I'll be revealing a lot of these investments in this video, but I'm also putting together a video on that investment strategy the rich use, why they have so little in stocks, and how you can replicate this strategy. So be sure to click that red subscribe button and the bell notification to see when that video comes out. But I'm a stock market analyst. I love talking about equities, and that's where I spent most of my professional career. So let's talk stocks in 2019. Since the bottom of the recession in 2009, the S&P 500 has produced a 9.5% annualized return, and tech stocks have done even better with about a 15% annual return. Now that's way above the long-term average for stocks, but there's no reason why you can't keep booking those returns. It's just a matter of finding the stocks that are going to lead in 2019. Investing over the next couple of years in stocks is going to be tricky though. All the recession indicators I follow, from consumer loan defaults to producer prices and sentiment, they all point to that high likelihood of weakness in the second half of the year or in 2020 at the least, and I'm not alone. The Wall Street Journal surveyed economists on when the next recession would come and found that more than 2/3 were predicting in 2019 or 2020. Now, considering that stocks usually sell off an average of 6 months before the recession starts, that means investors need to start positioning their portfolio now for what's going to work, and it's not in tech stocks. But there is one sector that could surprise to the upside this year and beyond. It's lagged some of the others since the financial crisis, but it has a clear runway going forward, and that's financial stocks. We covered this in the previous video on our Warren Buffett investing series because banks happen to be one of Buffett's biggest investments at around $50 billion, or about a third of his portfolio. Most investors just don't realize how hard it's been for banks to make money with those post-crisis regulations. For better or worse, those high capital requirements meant that lots of cash sitting around not being lent out and not making any money. Now that's meant that the bank stocks have underperformed other sectors, but it's looking like they could bounce over the next few years. Banks are facing a perfect storm of positive factors, from rising interest rates to lower regulations and fees. Now, I'm all with the Buffett on this one, and it's one of my top sector picks within stocks. Now, we talked about a couple of individual stock picks in that Buffett investing video. I'll link to that in the video description below, and make sure you check out the rest of the series where we break down all of Buffett's top investments, including his biggest tech stock pick and his worst investment ever. Within stocks, I also like the utilities and telecom. Now, these are two safety sectors that have underperformed as the economy boomed, but they're going to be your wealth insurance if the stock market tanks. Not just that though, they've also both got some huge catalysts for growth coming up. For utilities, it's those regulations that are being loosened that are going to free up a lot of cash to be returned to investors. For telecoms, a lot of them have already made their big investments in those 5G networks and other capital spending, so they're over that big hump in expenses. Now they're ready to start reaping the benefits of those investments over the last few years. So for this, you can start with investments in the sector funds. So the SPDR S&P Regional Banking ETF, that's ticker KRE, the Utilities Select Sector SPDR XLU, and the iShares US Telecommunications ETF, or the IYZ. These are going to give you that broad exposure to these sectors to benefit from the trend in higher stock prices, and you can pick a few individual stocks from each, the best of breed names for separate investments. Now, I'm not saying totally ignore the other stock sectors, but these are going to be the ones to watch in 2019. If you've got limited funds to invest in, so if you can only invest part of that $1,000 in stocks, then this is where you want to put it. Those of you in the community know I'm big into real estate. I've been an investor or analyst since getting out of the Marine Corps in 2001, and I love it for that long-term wealth accumulation. Real estate bounced back in a big way after the recession and has outperformed stocks for most of the last decade. Now, we're using the Vanguard REIT, a diversified fund of commercial property, as a proxy here, and you can really see that major shift in early 2017. It was here that the higher interest rates started hitting those sensitive sectors like property and bonds, and real estate has actually posted negative returns since then, though cash return has remained positive. Now, we all know that the retail property space has been weak for years, with malls and store closings against online competition. But the other property types are still going strong. Office and industrial space are growing along with the economy, while residential, hotels, and storage are getting help from the consumers. Rising rates aren't going to help through 2019, but there's not much to change that picture. A lot of the ways we can get real estate exposure have come down from those overpriced levels of 2016. Now, with real estate, you're not going to be getting much with $1,000, but there are ways you can get that exposure to this amazing asset. First, there are those exchange-traded funds like the Vanguard REIT we looked at here. That's ticker symbol VNQ. The fund holds shares of 185 real estate companies in every property type and spreads those out across the country, so you get that diversification for just $83 a share. I've also just published a video though with 7 real estate strategies that require no money down. These are the same strategies I started with out of the Marines. Strategies like the lease option or special government loan programs and wholesaling that you can use to get into real estate without that fat wallet. So I'll leave a link to that in the video description below. Just like with stocks though, there are some of those broader economic risks to real estate, like an eventual recession and rising interest rates. Unlike the housing boom, we're not seeing a ridiculous borrowing in property or prices, so there won't be that bust when the economy does weaken. Millennials are just getting into their prime earning and home buying years, so I think residential is still a safe bet as well as storage. Industrial and office property would probably be a little weaker in a recession, but really the only wild card here is that retail property, so that's probably the only one that I would avoid if anything. Even if we see a slowdown in late 2019, you're still going to see those solid 10% plus returns on REITs, and I think you can do 15 to 20% on direct ownership, so managing a few rental properties over the next few years. I want you to be diversified here though, and this is one of the most important things in real estate is to have some of that direct ownership in properties, but also some REITs and maybe even some real estate crowdfunding so you get that exposure to different property types in different regions. Now, our next investment for 2019 is a fun one and one that kind of blurs the definition of what we usually think of about investment, but according to a study by researcher Dalabar, art has been a solid investment. This study was over the decade through 2013, and you can see that fine art produced an annualized 7%, which actually beat out just about everything else except the US stock market. The big winner here was the Chinese art from a boom in demand from a growing class of Chinese rich. Now, I've seen other studies that claim different returns from around 10% to one by Stanford University that claims 6.5% annual returns. Either way, that's a solid return from something that's producing something other than just monetary gain, right? The great thing about art or any collectible is you still get that enjoyment from them even when the investment return isn't there. The economy can go to crap, but you can wait on that return to bounce back, and it wouldn't matter because that Banksy is still a conversation piece whenever someone visits. Now, the main way to buy art and other investment collectibles is through an auction house. Now, this is probably the best because you get some guarantee that it's authentic and has some real value. There are regional auction houses that can actually be better deals than those big markets in New York or LA. There are private investment groups you can join, and this is a really good idea for beginners because you get that crash course on what's valuable and you can pool your money to buy something in a little bit higher bracket. Of course, the risk here is that your chihuahua in a teacup painting is never worth much more than a teacup or a chihuahua. A lot of art doesn't appreciate, and it's just as bad or worse for other collectibles. My dad and I had around 12 boxes of comic books collected up into the early 90s, but only a few of those individual comics were ever worth much of anything. So this is one where you need to know a little bit more about that investment. What's it sold for in the past and why? It helps to be part of that investor group or a club to learn about these things and can actually be a lot of fun learning and hunting for investments. Keep this one more of a hobby investment to start. Take your time and maybe get a few pieces, but stick with those financial assets for most of your money. Now, this next investment is going to factor heavily into those 10 Wall Street lies I'll be revealing later in the video. In fact, this is probably one of the worst on that list that keeps regular investors out of those investments that make the rich even richer. Our next investment asset is equity crowdfunding. Now remember that table where the rich invest their money. This is startup investing. Equity crowdfunding is just like venture capital where you're investing in early stage companies that haven't issued on the stock market yet. This is where I spent a lot of my time working, and it's an amazing area of investment. This is how Mike Markula turned $250,000 into $200 million in just 3 years after he became the first outside investor in Apple. This is also how Peter Thiel made $2 billion, 40 times his investment when he got into Facebook for what amounted to be about a penny per share. Because the government doesn't trust regular investors, anyone with less than $1 million net worth can't get into this world of venture capital. For a lot of years, I advised VC firms and private investors, but couldn't even invest my own money. But that's where equity crowdfunding comes in. Through websites like EquityNet, CircleUp, and Indiegogo, you can invest in startups and get a piece of these companies before the rest of the market. These are small companies just starting out and include everything from film projects to digital platforms and distilleries. It can actually be a lot of fun looking through these different startups and becoming part of one through an investment. But startup investing is one where you really have to be careful, even more so than with stocks as you get further into the economic cycle. These companies are just starting out and many don't have that financial flexibility to withstand a recession. When you're looking at these crowd investing deals, you really want to be extremely picky and only invest in the ones with the strong financials and a competitive advantage. I won't try to talk you into investing in these deals. It's a job in itself to analyze these deals and you don't necessarily need them in your portfolio. I will say that the returns are amazing though. A study by Willamette University found that the average returns on angel and venture investing was around 26% annually, and that's accounting for the fact that a majority of the investments are going to be bust. This graphic here shows that 55% of the deals return less than the investment, while maybe another 35% might return the original investment up to 5 times your money. But it's those big winners that average out their returns to 27% a year. That's a 1 in 10 investment that returns 10, 20, even 30 times your money. Now I've got a video that goes a little deeper into analyzing these deals, including how to look at the financials and how to make sure that management is on point. I'll leave a link to that in the video description below, as well as a link to this book, Investing in the Next Big Thing, which details my entire process analyzing startup investments. Everything I used when I worked for venture capital investors. Our fifth investment here for 2019 is gold. It's amazing how quick all the shady gold investing newsletters and coin dealers went away when the price crashed from $1,900 an ounce in 2011. Since 2014, gold has done absolutely nothing. Now, there are a few factors holding gold back from being a viable investment, but there are a few clues that are emerging that might change things next year. First is inflation, which has been pretty much non-existent since the end of the recession. As a real asset, one of the big selling points for gold investment is that inflation protection, so taking away the risk that prices head higher. The other factor holding gold back is kind of a trifecta that's all related. Higher interest rates, a stronger dollar, and a relatively strong economy. That strength in the economy is causing the Fed to raise rates, which in turn pushes the value of the dollar up against other currencies. The problem here for gold is threefold. First, a strong economy means a lot of other investment choices in stocks and other assets. Gold has no appeal as a safety asset in this scenario. Second, because holding gold doesn't pay any return until you sell it, those higher rates make other safety investments like bonds more attractive versus that yellow metal. And finally, since gold is priced in dollars, as the value of the greenback goes up, the quoted price of gold comes down. Now, all this, and you wouldn't think that gold would be on our list of 2019 best investments, but those factors could change very quickly. We're already seeing the beginning stages of higher inflation with consumer prices inching up past 3%. $1 trillion annual deficit is going to start weighing on the economy and those other investments, which could bring back the appeal of the safety investment. But the best reason to put gold on your radar for part of that $1,000 investment is that nobody sees it coming. The price of bullion has done absolutely nothing for 5 years. Gold miners like Goldcore are profitable at about $1,200 an ounce, but the shares have been absolutely hammered. Here's Goldcore down 80% since 2011 peak and down 27% just from the 2018 February high. This is a $9 billion company with solid fundamentals that use to pay monthly dividends, and investors have completely written it off. Now, I wouldn't be investing directly in gold because it pays no dividends while you hold it. If you want to invest, go for those miners that are profitable so you get that dividend yield and the lottery ticket on the higher gold prices. The sixth investment we'll talk about here before getting to my top 3 ways to invest $1,000 in 2019 is going to be peer-to-peer lending on Lending Club. Now, there are a lot of haters out there that are talking about how P2P loans are a bad investment or that returns have been coming down, but I just haven't seen it. I've been investing since 2015 and returns have been consistently around 10% a year. I think a major reason why a lot of investors are seeing lower returns is because they're not using a loan filter to manage those investments that they buy. Yeah, if you just invest in any loan on the site, you're going to see the crap with the good. That's why I developed a loan filter that puts me only in the best loans, keeps me out of those loans that are going to default, and really keeps my returns higher. I revealed that loan filter in another video and showed you how to set up the automated investing tool on Lending Club to make it almost a completely hands-off investment. So I'll link that in the video description below. Make sure you check that out. I will say there are some risks in P2P loan investing as we head into 2019. We're seeing charge-offs increase in both consumer and credit card loans. So defaults on credit cards are up to about 3.6% and consumer loans are up to about 2.2% here. Consumers are stretched thin, and without wage growth, there could be some pain in P2P loans. But you have to compare that to what's going to happen to stocks if people stop paying on their debts and we head into a recession. Stocks could easily crumble 50% like in 2008. While that 10% return on P2P might come down, a lot of those people are still going to be paying on their debts, so it's not that risky of an investment that people are trying to make it out to be. Our last investment, and this one isn't a traditional investment like the others, but it's one you should consider as an investment in a business. If we go back to that table of how the rich invest just one more time, we see that millionaires of the world have 1/4 of their wealth in their own businesses. Now that's more money than in any other investment, stocks, bonds, real estate, anything else. That should tell you something right there. Most people wait for someone else to make them rich. They invest in stocks of a company and expect that company's management to produce profits that are going to make the investor rich. Instead of waiting around sitting on their asses, the rich make themselves richer by investing in a business. I made a lot of money as an equity analyst, but it was still a fraction of what I make now with my own online businesses. Best still is that my businesses have grown to a point where I can sit back and relax and they'll still cash flow. I don't because I'm stupid like that. I need that adrenaline from working hard and building the businesses, but I could if I wanted. So just one more resource I want to point out before we get to those top 3 investments. I recently finished a video that lays out the blueprint for the characteristics you need to develop and 3 business models I've used for 6-figure income. Now this video walks you through not only those 3 business ideas that anyone can use, but also the action steps that are going to make you successful. It's there linked in the video description below, so check that out when you're done here. Now you've only got $1,000 to invest and you're not going to be in all of these. That's fine to start with. I wanted to share the 3 best investments that are going to get you started, and then you can invest in the others as your wealth grows. First off though, understand it's not going to be in stocks. In a good year, stocks might produce 10 or 12% return, but there are some very real risks in 2019 that could hold them back from that. I'm not predicting a full-on crash, but things could get dicey in the second half as investors look to that 2020 recession risk. And as much as I love the potential in equity crowdfunding, you're not going to get much for $1,000, let alone a few hundred. That's fine. The beauty of this startup investing is that there's always going to be companies raising money from investors. Wait a year or 2 when you've got more money to invest, when a recession has kicked the butt out of most of these new companies, and then get in on some great deals. The same goes for art. You're not going to get that much with $1,000. So we're down to gold, real estate, P2P investing, and your own business. Now gold and real estate were really the heads up tie here. There are strategies I share in that previous video that you can use to invest in property with no money, and I truly believe that everyone needs real estate in their portfolio. But there's a reason why I'm going with gold for one of my top 3 investments for 2019. First is just that contrarian opportunity in gold. Nobody thinks it's going to do much. Everyone has written off gold miners, so you can get some great deals on these shares. You can invest in a few individual companies like Goldcore as well as the VanEck Vectors Gold Miners Fund, that's ticker GDX, for a broad diversified bet. With gold, there's that upside potential, but also another reason I'm recommending it along with these other 2 investments. But let's look at those first. My other top picks for that $1,000 are P2P loans and your own business. Now, P2P offers a great mix of that safety from a fixed income investment, but returns that are similar to stocks, so it's really the best of both worlds. With that business investment, I want you to stop waiting for someone else to make you rich. By creating your own business, you're going to be creating those assets that are going to work for you long after you've stopped working. So there's a method to my madness here, why I picked those 3 investments over the others, and it goes back to that way that the rich invest. The reason why the rich have so little in stocks is because they already have a lot of risk in their own businesses and their other business investments. They don't want a lot of risk in their financial assets as well. So with these 3 investments, gold, P2P, and your own business, we're balancing that risk and return. An eventual recession isn't going to hit your gold and P2P investments as hard as it would stocks, and they'll continue to cash flow. In fact, a recession could be a good thing for gold, sending prices way up as a safety asset. Investing in your own business is riskier, but it's something that you can do with little money, and the return potential is well above any of these other investments. Be sure to check out those resource links I left in the video description below for some of those investments. I've also linked to the free report revealing the top 10 lies Wall Street tells investors. Again, if you only have $1,000 to invest in 2019, go with these top 3, but all 7 should be on your radar. This list of the best investments is going to build you a diverse portfolio with the potential for high returns and protect you from that stock market crash. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just scroll down and ask it in the comments, and we'll answer it in a future video.